Hi everyone, this is Finance Meets Real Estate. We have Viktor here today. He is the founder of Reino. So his company is actually the first company in the world to use tokenized real estate as loan collateral. And they offer real estate tokenization as a service, lending backed by tokenized real estate, as well as a crowdfunding platform for tokenized real estate. And it's a great pleasure to have him here today, as Viktor is actually a fellow Bulgarian guy just like me from our community. So we always support each other. And also he's a serial entrepreneur. So he has previously done like a few other projects in different domains, including online and offline retail, investing, M&A, commercial real estate, and current commercial real estate and lending. So he bootstrapped the biggest online sporting goods retailer in Eastern Europe and scaled the company to 7 European markets and 120 employees. And he was awarded Trade Business Leader 2017 by Business Class magazine for outperforming online sales of competitors like Decathlon by more than 7 times on local markets. So with that, and just a quick reminder that the event is going to be posted on YouTube as well. So if you guys want to join, it's Finance Meets Real Estate on YouTube. Make sure to subscribe. With that, I'm going to pass it on to Viktor.
Yeah, thank you, Stefan. So it's a pleasure to be here. Thank you for the introduction. Basically, yeah, as Stefan said, I'm a serial entrepreneur. I have started my first business when I was 18, and I have more than 15 years of entrepreneurial experience so far. 3 years ago, pretty much I jumped into the blockchain space and started my real estate company. I mean, it's a fintech company actually. So it's pretty fascinating space right now, and it has so many opportunities. So I'll try basically to give you my perspective regarding the tokenization of real estate, and as well as other innovations in that space that are coming, and it's quite exciting overall. So the main problem basically in commercial real estate space is liquidity. So back then in 2017, 2018, I met a lot of family offices with most of the family offices are usually having a part of their investments in real estate. So what they told me at that time was that they're holding a lot of real estate, but it's sort of illiquid, and we need to find a way to basically through tokenization or through blockchain technologies to find a way to provide more liquidity, to be able to close transactions faster, and to exit them even faster as well. So that being said, I started thinking about solution, blockchain-based solution. As at that time, I had started working on blockchain bank concept, but I figured out that probably with the technology that we're building, we can start doing something in the real estate space, and then Reno came up as a concept, and basically we have started working on tokenizing real estate and a new lending solution. When I get deeper into that space and into the problem and what is providing the main liquidity at the market today, we realize that this is actually the debt market. Pretty much more liquidity is coming from debt than from buying and selling real estate. So that's why we have created our lending solution as well. However, let's go back to the tokenization and why the tokenization itself is going to be the new foundation of real estate trading, buying, selling, investing, and so on. The idea of tokenizing real estate is basically to make it more accessible for a new type of investors. So let's say that you're having a building that is worth $10 million, and it's definitely not accessible for everyone in that manner, because usually if we're talking about a commercial real estate space, you need to put 30% down in most of the cases, which means $3 million. So not everyone is able to provide $3 million to participate in this deal. But if this deal is separated to 10 million pieces, and those pieces, you can buy only part of it, like 2,000 people could participate in a single transaction, then basically you can reduce that initial investment to even $100 or $1,000 or something like this. And you basically can create fractional ownership based on that fractional, based on that asset. So allowing more people to participate usually means more liquidity, and you can see that right now in the apps like Robinhood, where when you streamline the process of investing, you can get access to more investors overall. So and how liquidity, and apps like Robinhood are boosting liquidity for the capital markets right now, and the prices are mainly going because the accessibility. So it's similar with tokenization. Basically, you're having a lot of fractions that are representing real estate, and a lot of small real estate investors can participate pretty easily. However, if you think about it, we still have some solutions like this already in place, like crowdfunding platforms, where people can invest small amount of money into a real estate project. But the crowdfunding platforms are not solving the next problem that is coming, and it's you can easily get into the deal, but you can't get out easily. That's the problem. So you don't have secondary market for the investment that you're making in the crowdfunding space. How this actually could could be solved, that's where the tokenization is coming into play. Instead of holding this asset for 3, 5, or 7, 8 years, like that's usually the time frame, usually about 5 years that you need to hold such type of investment. You can basically at any given point decide to sell your assets, and without waiting for a general partner to decide when you want to exit or something like this. Whatever you feel comfortable, when you have a secondary market, you can sell your tokens, and you can get out from this investment. Or the opposite, instead of general partner to decide when to sell the building, which might not be the perfect moment from your perspective. For example, you can decide to hold it for a longer period. Another factor is that basically you can decide also to basically borrow money whenever you want to, if you want to. So in terms of working in a single transaction and investing in, let's say, REIT or a crowdfunding project, basically there is a general partner that is deciding what's going to be the debt to equity ratio, what are going to be. I mean, it's not deciding by itself, but it's moving those relationships with the lenders. So imagine at some point, situation like COVID happens, and what is happening in some of the cases, tenants are stop paying their rents, and you have invested, let's say, $10,000 in a $10 million project. Um, what is basically happening is your investment now is at risk because the property is not producing any cash flow, and what you can do at this time is just to wait and see what's going to happen. You can't do much, even if you're able to pay your part of the debt. So if you be able to borrow money separately and decide what's going to be your risk, you can borrow with tokenization. You can borrow only against your $10,000 of equity, and repay your loan with another cash loan that you're having, just to pass through the bad time that is just temporary. It might be 6 months, it might be a year or something, but you could be able to pay that. But if you need to pay 10 million or 7 million in debt, which is going to be the case, you're not going to be able to support that, and you might lose 100% of your equity just because of bad momentum. That's the difference. So the bottom line is that, yeah.
Sorry to interrupt. And a quick question. So how is pricing determined in the secondary market upon selling a piece of commercial real estate, let's say, under tokenization? And do you see any, let's say, from the perspective of an investor or, for example, a multifamily syndicator, do you see any potential for liquidity premium there, sort of raising the value of the property by tokenizing it?
Sure, absolutely. I'm definitely seeing first some potential premiums because of that. But usually the secondary market price is determined by supply and demand, and mainly the underlying asset, how much the underlying asset is producing, for example. But the liquidity premiums could come just because of if you make the process easier, so to say, you can definitely create value that I mean, if you can buy quickly and exit quickly as an investor, you're gonna prefer to invest in such asset compared with go through the entire paperwork with a regular transaction, and be locked for a super long time. So having this liquidity in mind, and investors are gonna go more and more comfortable investing in tokenized real estate, and also having liquidity where I'm gonna start talking about the lending piece, and you're gonna see how quickly you can get financing. So I mean, pretty much instantly based on those assets. So that being said, imagine that you can close a transaction and finance it the same day, and compare it with the traditional approach, and you're realizing how much time you can save, what is the amount of effort that you're basically saving.
Right. Yeah, that makes sense. And just as another question, like what are typical at this point in time? What are some typical sort of percentage, owing costs for tokenizing a piece of commercial real estate? Let's say as a percentage of the price. Like, would it be like 1%, or like is there like a general sort of current state in the? I mean, I know it's a super starting industry, it's so evolving, etc. But still, is there where are things currently?
So there is no percentage to tokenize real estate. It's just we're trying to make it free. So we're trying to make free tokenizations overall. If, for example, you want to borrow or replace your mortgage, we're tokenizing your property. giving you a rental loan instead of a traditional mortgage, and then basically the idea is that you're just this is just part of the our loan procedure, and the cost is basically involved in the interest rate, which interest rate is going to be pretty similar, if not even a bit lower than a traditional mortgage. Depends on the case. The only thing is that our lending solution works only for income producing real estate. It's not like, it's not covering fix and flip type of deals or construction projects. It's mostly for stabilized properties. But other than that, basically the cost to tokenize property could vary based on different companies. So I know companies that are tokenizing property for $200,000, pretty much so, and we can do that for free. So I'm not saying that it's it's not worth it. That's why it's free. I mean, it's the opposite. Basically, it's a lot of legal work involved, but if our goal overall is to provide as many tokenizations as possible and to tokenize as much real estate as possible, and to create this kind of environment where people are interacting with digital assets, in digital real estate, so they can start feeling the benefits and transacting more, more real estate through in a digital form, so to say.
Got it. Thanks.
Yeah. So let's go now, and I'll try. If you have some question, guys, feel free to ask me while I'm still on the tokenization topic. And I'm gonna cover a little bit, the lending side of the business, pretty high level, and then we can have feel free, to have some sort of open discussion about it. That's the point. I think that's better and more productive, in my opinion. So.
Yeah. Feel free, feel free to put your questions in the chat if you like. That's more convenient. That works as well. Or just speak up at any time. That's okay.
Yeah. So let's then jump to the lending part of it. As I mentioned previously, the tokenization itself, it's a very important part. You can syndicate deals with it. You can participate in various deals with small tickets. But yeah, I mean, big part of that is to have a debt solution that is going to work pretty well with tokenized real estate, and to be able to leverage, also increase your return on investment. So basically, that's why we have developed our lending solution, which is we are the first company in the world to basically provide something like this. While in the tokenization space, there are other companies that are working in that field. On the lending side, it's pretty fascinating what could be achieved. So in terms of time to close the deal, time to paperwork, for example. So the initial process, basically in order to tokenize building, is pretty similar to a traditional mortgage, so to say, because we're collecting all of the data. We're doing some due diligence to the property. Basically, we're collecting all this data that is related with the cash flow of the building, tenants, and so on. But when we got the data, we basically could provide instant loans. based on that. And that being said, what is actually happening is that we are pre-approving property to be used as collateral, and then if you want to sell at some point your piece of property, the buyer don't need to go through the entire through the same process of submitting documents and so on. So basically, based on the tokens, we're having a lot of information incorporated in those tokens or associated with those tokens, and we are using this information for instant approval for the new buyer. So whenever you want to sell your equity, basically you can do that, and the new buyer is pre-approved pretty much to buy it. So and to get financing for your assets. So having something like this in mind, basically it's providing a streamlined and super easy way to basically close deals for you, and actually bringing this liquidity premium, because probably most of you have done some transactions so far in the traditional space, and you know how hard it is to go through the entire process over and over again, submitting documents all the time. The process could take between 2 and 6 months, and for bigger deals even more to close, as well as you need a lot of attorneys and so on involved and intermediaries involved in the process. While imagine that you can basically sell to somebody and they can finance the transaction and you can close the same day. So that's a game changer, and it's gonna lead to liquidity freeze. I think we have some question. Should we respond now or?
Yeah, sure, that's fine. So the question is, the question is supposedly from Johnny, suppose I have my LLC company with 250K property that is not paid off. If I tokenize this real estate property, does it mean that I can borrow another new mortgage against this property to purchase another 250K property?
So you have property with 250,000 that is not paid off. No, you can't borrow twice for the same property, basically. So when you tokenize it, it doesn't mean that you can, have one additional loan based on that. Basically, what is happening is when you borrow against tokenized real estate, first we are replacing the mortgage, the current mortgage, and then if you have some additional equity, you might refinance, for example, and take some of the equity back. But it's not gonna be like we're gonna double your financing, something like this, because it doesn't make sense on our side.
Right. So I have a question. So I visited your website, your company website. So I noticed that you have a Delaware-based LLC. So supposedly I have my own LLC and work through you. So there is really no problem, whichever state it's based up, right? Okay. Yeah. Because I'm not a real estate professional in terms of tax purposes, because I have other full-time job. So if I take a loss on real estate, I'm not able to tax deduct that because I would never qualify as real estate professional. So I see value in tokenization is if I own a property that is very expensive and I take too much loss, is that supposedly I can tokenize it at that point when I'm start seeing too much loss and then sell them some of the equity off? You guys, two company provide that?
I'm trying to basically understand the question.
Yeah. So I'm just playing scenario-based situation.
Mhm.
So let's say I don't have a tokenized real estate right now.
Yes.
So yeah, suppose
Yeah.
I have, so I have, let's say I form LLC company, my own company. Hopefully my full-time job will never find out. But I LLC company and I have buy $1 million property, right? And then I realized, oh wow, I'm not getting a tenant in there. So in the summer middle through the time, I'm not getting tenants, I'm not getting rental income. So I'm taking some losses at that point.
Okay.
Some people who are full-time real estate professionals, they can tax deduct the losses, but I'm not, right? So I'm looking at, well, I want to liquidate this. Either I want to balance out some of the risk here, and can I tokenize it at that point and sell off some of the property equity at that point? So that's my question. Yeah.
Yeah, I mean, you can tokenize property in any point, but you know, from a lending perspective, in order to make it eligible for loans, so to say, we're not much different than than a bank or financial institution. We still have risk factors, for example. So if you're having a property that is not producing income, so to say, we're probably not going to make it eligible for loans on our end. But you still can tokenize it, and you still can sell part of it to somebody that could believe that this property is gonna turn around and is gonna start producing cash flow. So or for any reason, I mean, you can tokenize even piece of land that it's not producing any income, or even you can tokenize future development and do something like this, so you can syndicate a lot of investors to participate in a construction type of project.
Right. So because in a sense, if I tokenize it, I'm selling off part of ownership, right? So if I tokenize half of it, but can I take it back?
No, I mean, if you sell it,
that's gone.
It's gone, yeah.
Okay, all right. That's not a good thing. So I'd rather pay with my paycheck, I guess. All right, thanks.
Yeah, I mean, it's like stock market. You can't, sell some of your stocks and then buy them back if the buyers don't want to sell it. They're gone, or you might buy them back at a higher price. Depends on the market price, pretty much. And because properties are not like stocks, like freely flowing everywhere. It's you might not be able to buy it back. So it depends on the buyers. While if you're using part of your tokens as collateral, that's different story. Then you can repay the loan and you can take your tokens back. But if you sell them, it really depends on the buyers if they want to.
If I may interject, Janice and Viktor, I mean, I guess maybe your question then maybe sort of if it is value creating in a way, is that kind of like, let's say if you tokenize, that it would be more the direction of thinking. I don't know if, I mean, I wouldn't think that, let's say, tokenizing is going to change too much the tax implications or stuff like that in that sense, right? I mean, I would doubt. I mean, it could potentially, but still. Now, in terms of your, I don't know what you meant by saying you have to be a real estate professional. I mean, if it's a business, like if you have your LLC, I mean, that would operate as a sort of income and expenses, and you would deduct your losses in that scenario. Now, if it's a single member LLC that is on your personal tax and I'm not a tax professional, of course, then yeah, that could not be the case in that case. But generally, I mean, if you have it as a business, you don't have to be a real estate professional. But yeah, I mean, I think to me, the interesting question, is it really value creating? Can you potentially sort of have a more valuable property by tokenizing it? I think that's still an open question, because I think that's sort of the debate around, I guess, what I mentioned previously, liquidity premium. I don't know to what extent that, you know,
Yeah.
because I had I'm not sure some of the people here might have been at the meeting with Yao Tamar like a couple of weeks ago. So I think she was suggesting on a specific piece of commercial real estate, there was a sort of a value creation through liquidity premium of, I believe, 20-30% on that specific piece. So I don't know if that's generally the case. I'm sure it could fluctuate afterwards, and you know,
it might go either way. So
right, yeah,
not necessarily, you know, it should goes, you know, to create more value because it's tokenized. It could goes either way. But usually, you know, when you make the process easier for investors and other participants, you can have more demand for the same asset. So more demand usually means premiums. So that's
right, yeah,
that is how you can create value. But overall, I mean, just because something is tokenized doesn't mean that, you know, you're gonna get more, so to say, a higher loan at better terms or something like this. It just makes the process super simple in terms of, you know, borrowing, closing the transaction and stuff like this. So those um, new efficiencies that are created, basically resulting in opportunity costs. One way, you know, basically, because if you deposit your money into an escrow agent, for example, and hold it for a couple of months without doing anything, basically you have an opportunity cost at that time to make money somewhere else. So if you close right away, you basically start making money right away, pretty much out of this investment. And that's only part of the, you know, the opportunity cost. You know, the timing that you're being involved to close a typical transaction basically should be calculated as well. So all those inefficiencies on the market right now are causing us money indirectly. So either because of our time, because of cost of capital, and so on. So this is a value that we need to, you know, basically we can measure somehow based on the, you know, uh, based on our time involvement in the process and so on. We can execute much more, so many transactions at the same time that we're just gonna close one transaction in the, you know, in the traditional world. That's a huge difference.
So Victor, if I'm hearing correctly, so you're almost offering this one-stop shop, right? For mortgage and all the paperwork and process, you say even fast and closing, right? So
Yes.
is that, yeah, so is that, yeah, because I mean, that's the efficiency that like someone like myself would look for, because I don't want to make 10 phone calls, right? So then is your company pretty much bulking all of that and then offering that solution then? Because I'm not really like particularly worried about a tax deduction, but I'm just trying to think of what this tokenization really mean for me, you know? Yeah.
From an investor standpoint, basically for you, it's going to be much easier to get in and to get out from such investment, because, you know, usually smaller investors, they don't have like millions of dollars sitting out there for real estate transactions. Sometimes, you know, you want to invest in something, just your money to produce an income while they're sitting there instead of sitting in the bank account, for example. But at some point you might need to do something with those funds, and you want to get out of, at least partly, for example, from such investments. And that's what actually tokenization and is actually bringing to the table. But also you might have a better opportunity in front of you, and you want to exit quickly, not to miss something. So sometimes this opportunity cost of holding an asset and not able to liquidate might cost you a significant, profit, potential profit loss, missing great opportunity. So that's another thing that you can basically, from an investor standpoint, consider when deciding either to invest in a traditional way or to tokenization.
Right. And do you have target deal sizes currently for tokenizing and lending on tokenized real estate? Like, do you do any deal size? Let's say would you do a deal for a small investor, or is it currently above a certain threshold?
You mean, are you asking me?
Like, yeah. If you have like target deal size, or it's anything up to, because I know your lending mentions up to $50 million. Lending.
Yeah, I mean, we're limiting the lending piece, but there is no deal size limitation. Probably we're trying to have even some deals like 400, 500,000, something like this, like $500,000. It's gonna be the lowest possible tokenization project, so to say, because actually there is a lot of work involved, and we are trying. It doesn't make sense if you go below a certain point, even to manage the structure to have tokenization, so to say, because imagine to have like public company. It's not exactly like this, but just as an example, to have a public company that is too small, you can't afford to do that. It's gonna take so much, a huge part of your income is gonna go to just comply with regulators, audits, and all the requirements. And here, with tokenization, you basically, from our standpoint, we are preparing a lot of documents, like Regulation D offerings and so on. We are still need to comply with SEC, and then you need to basically work with a lot of investors, so you need to be completely transparent. So yeah, probably have a property management company, and for super small projects, it's not going to work.
Right. Okay, that makes sense. So let's see if we kind of like play a scenario like for a 500,000 purchase, right? Let's say it's your smallest deal size, and you have sort of, I have identified an asset in, I don't know, I'm in New Jersey, let's say New Jersey for 500,000, right? And I want to buy it. So what are going to be some of the sort of obstacles that we need to overcome? So the seller needs to be in agreement, obviously. First, that the asset be tokenized. Like, what is your experience? Like, what are, a transaction by transaction, in your practice, what are some of the things that I, as an investor, would want to overcome in order to get it done actually this way? And what would be the closing costs? Because that you mentioned there could be some SEC involvement. I know that sometimes could raise like a bit the attorney costs, etc.
Yeah, so it really depends on the transaction. So if you're talking about purchasing a property that is worth $500,000, the seller should not be involved in the tokenization, or be aware with anything that is going to be tokenized or something like this, or agree with that. It really depends how you want to structure the deal, and that's what the tokenization is basically. I probably missed that part, and but just for you guys to understand what it is, it's a special purpose vehicle. This is a Delaware-based LLC that is created, and which shares are digitized. Instead of having a paper certificates, you're having a digital certificates in the form of tokens. So that is what is token. that is the initial phase of tokenization. So basically, you're forming an SPV, and you can syndicate, with other investors, or even to purchase the property. So you basically could sign a contract between this SPV and the seller and say, hey, I want to buy this property. Then you're tokenizing the shares of the SPV, and you can go, and syndicate with friends, or you can fundraise through Regulation D, basically, or Regulation S, this deal. And when you get the funds to do that, basically you can purchase the asset, and that's it. I mean, it's a pretty simple way to syndicate. It's just, instead of having traditional share certificates, you're having the digital certificates. But in order to get deeper into it, and for example borrow money and so on, then that's going to require a bit more documents, for example. So you can get 30% of the deal, let's say 150,000 out of friends or syndicates, with other investors, and the rest you can borrow, for example. So in order to borrow, then we're acting pretty much the same as a regular lender. So we're collecting all this data, we are analyzing, we need an assessment, and so on. And usually, one remark, we are doing it for commercial properties only. So if this is a single unit or a single family, or up to 4 units, we're not actually financing deals like this. But let's say that it's 5 units multifamily that is worth 500,000, which probably, I don't know if you can find in New Jersey, but so basically, then we can provide the loan. However, the difference is coming not at this moment. Sorry, Stefan?
Just confirm me, like you said, you only do commercial. So if it's multifamily, it's 5 units plus. Just confirming. Yeah. Okay, sounds good.
Yeah. So let's say that now you have the property tokenized, and you have a loan. You have borrowed from Reno, so to say, and you're using the token as collateral.
And sorry again, just one more thing. Just when you say you have the property tokenized, so at which point that happens? Because you said, okay, you have in the SPV like the formation of digital certificate tokens, call it, right? So those digital certificates, you said upfront, while you're capital raising from your investors, for example, you can do that. But
yes, you can tokenize prior to having the property there.
So ahead of changing title.
Yes.
How does that work? I'm not exactly sure. So basically the property is still owned by the seller, but you're issuing digital certificates against what exactly in that scenario, while it's still owned by the seller in sort of regular title? It's not with
I mean, you're issuing digital certificates which are representing shares in an SPV. So those are regular shares. So imagine that instead of
So you can just do it like sort of flexibly. It's just shares against the SPV.
Yes, and you can distribute those shares instead of in a traditional way, in a digital way. So it's easier to distribute that.
And when you say the seller doesn't need to know that, so wouldn't he be impacted at some point during the closing process? I mean, he would sort of become aware that you're doing this obviously more innovative thing, which might seem too complicated to the seller, etc. No?
No. I mean, it's just imagine, we are here. I don't know how many people now this chat. We're getting together. Like, okay, let's say we are 10 people to just make it easier. Any one of us is putting like $100,000, and we have $1 million. pretty much that we're, or see it that way, you know, every one of us is putting 100,000. So we have $1 million that we want to invest. We're creating an SPV. We're distributing, you know, 10% of the shares of that SPV among any one of us. We're putting 100,000 in that SPV. So now the SPV has $1 million going, and this SPV has a contract with the seller that you know, purchase agreement with the seller. So we're basically going there, giving them $1 million. We're not talking now about any debt or something, and we are buying the property, and that's it. And it's all set. Any one of us holds now 10% from that property. So that's how it could be done. It's just a simple example.
So Victor, I have a question. So like, let's supposedly the SPV, so like digital certifications are issued when that. So as a seller, like, let's say I'm just gonna make scenarios. So I have like $1 million commercial property, for example, make math easier. Like I say, you say, you know, I want to tokenize it and then have 10% sold off to somebody. Like, at what point am I getting money deposited into my bank account by tokenizing? So is it because I found somebody, like you say SPV found somebody, right, buyers, and then wait for a long time and then money get deposited at that time? Or am I, as soon as I tokenize it, SPV buy it, and then do I get money right away? That makes a huge difference, you know?
Yeah. So you're basically asking from the perspective of the seller, right? So if you're owning the building, that is worth $1 million, and you want to tokenize that property and sell it, is that what you're saying?
So my question is the timing of when do I get money as a seller of tokenized real estate property?
Yeah, if you are the seller and you want to tokenize and sell it in fractions, you're gonna get your money right away. Whenever somebody is purchasing something, basically they should give you the asking price for the tokens.
Okay, so that means as a seller, I don't have to wait until the buyers appear to SPV, right? That means that as soon as I tokenize it, value is determined, I get the money. Is that right?
You need to have a buyer, right? So we should agree that you have somebody to purchase it. It's just because it's tokenized, there are no money that will show up right away. It's just if you have a buyer to buy your shares, then you can execute a transaction. But if you don't have a buyer, you know, just because it's tokenized, there are no money. So to say, yeah.
And just, but again, okay. So I'm just trying to get it, you know, like another question. So for example, so when you have so the lending side, so I understand. Okay, so that changes, that becomes more efficient, you know, under this structure, etc. But still, like you're saying, like we're buying from a regular seller who doesn't even know about it. And so how then let's say assume there is no mortgage. Would you tokenize it then or no? Because probably to you it wouldn't make sense from a business perspective. Let's say if it's a cash purchase, for example.
Yeah.
Yeah.
I mean, we can tokenize it for a fee.
Okay.
For sure. I mean, if somebody wants to just tokenize property and not borrow money, I mean, we can tokenize it for a fee.
For a fee. Okay. Let's say that's not. Let's say like that. But just for simplicity, let's say there is no mortgage at all, so it's just like a cash purchase. You know, so normally there's going to be like the title work, you know, like recording, etc. So how is that going to play out in this scenario? It's going to be the same, not affected. The title sort of change, and that's why to the seller it appears everything is sort of the same. You know, I'm just trying to understand that.
Yeah. So I could give you different scenarios because it really differs, you know, and you can structure it whatever you want to. As I said, think about tokenization as owning shares in a digital form that's what tokenization is, generally speaking. So you can, have digital form of any sort of structure, so you can structure deals completely differently. There is not one way fitting all. So, but let's say if you're if you're a buyer and you wanna buy properties to syndicating investors in order to do that, basically you don't need to tell the seller how you're raising your funds, for example, and then the seller doesn't care. You're coming there with money and you're buying the property.
Okay, yeah, I get that. On the investor sort of capital raising side, right? That's sort of the discussion like with the seller, so the rest is sort of conducted the same, like the title work and everything.
Yes.
Okay, got it.
Everything else is the same. Basically, you can transfer the ownership then the same way.
Right.
Right. Then title insurances and everything else is the same for for the initial tokenization. Just to make a difference. So there is initial tokenization that is taking, you're basically having the same steps like in a regular transaction, but the difference is coming when you're selling. Then you don't need to go to the same thing basically when you're selling, because you can just sell your tokens. You don't need somebody a middleman to execute this transaction. I can send my tokens to Stefan, and Stefan can send his
markets. Like, what are some names of, like, for our audience, like some names of secondary markets currently where one can sell tokenized real estate?
So one market is Uniswap. Uniswap is a decentralized exchange for tokens, where everyone can, sell their tokens pretty much. And another regulated markets are so-called alternative trading systems, like T0. It's another market where you can check it out, but the property should be traded there, so it needs to be accepted. It's like mini New York Stock Exchange, so to say, or Nasdaq for alternative assets. It's not very well developed, but Uniswap is super well developed, having $1 billion worth of trading every day. So it's a well developed market for digital assets.
Can you go more into the actual loan creation, or is that something beyond the scope of this presentation?
Sorry, can you say again, Andrew?
Can you hear me better now?
Yes.
Okay, could you go more into the loan and the scope, because your service provider also provides loan for commercial real estate assets, correct?
We're providing loans against tokenized real estate.
Tokenized real estate.
Tokenized real estate, yeah.
Okay, so not hard assets. You'd have to convert it to tokenized real estate, then take a loan off of it.
I can't hear you very well, and I'm not sure exactly.
I'm just trying to figure out as far as the loan. So is a process syndication of a property and then tokenization of that property, or I'm a little confused about the flow path that I believe Stefan kind of went through, like a $500,000 asset. Are you tokenizing or are you syndicating using Reg D? How are you?
Yeah, I mean, you can go either way. That's why it's confusing. I'm trying to say that this is a flexible sort of option. So you might decide to tokenize and syndicate the deal, or you might decide to do it by yourself and still use the tokenization and borrowing money. That's how it works. So it's not that you need to first syndicate and then borrow or something like this. From our perspective is what is the asset that is basically we're taking as collateral. What is the cash flow? What is the risk associated with it? For example, if it's an office building, right now definitely we are considering this asset differently than, for example, a multifamily or retail, for example, are riskier based on location, for example. But those are risk factors for us as a lender. Nothing new on the lending space.
Okay, so you guys provide loans for commercial real estate assets, say like retail storefront, hotels, and such, is what I'm getting.
Yeah,
value ratio and everything else.
Yeah, multifamily. Yeah, just we are making the process easier visually. So even not necessarily you should go and we should create Reg D offering for you or something like this. We might skip this part completely, and we're now underwriting 2 loans totaling $12 million without even preparing any Reg D offerings or something like this. It's just the red lending, because the lending itself has so many advantages by itself, and I can get into that for pretty quickly. But the idea is that when you tokenize property, let's use this example of $1 million property. You're tokenizing it, then you're borrowing 700,000 to leverage this transaction. You're having 300,000 worth of equity, and at some point you're selling another property. You're having like 500,000 more in your bank account. Instead of paying us interest rate, you can repay 500,000 of the loan, and save some interest rates. So when you get to the point where you're having another deal on the table, you can again use the same tokens as collateral to borrow instantly. So in the end of the day, that's going to save you some funds. That's one example of why people could just tokenize and borrow without syndicating, without going and selling somewhere or any of this.
Yeah, and that's great
excellent.
for like saving you some funds. And I'm not sure if I'm interrupting, but I want to confirm though from the perspective of at the purchase, right? So for example, in the current usual model, like one would hire, for example, an SEC attorney if one had a syndication. Let's say it's $1 million deal, right? One would pay $12,000 or something is the fee, like, or 15 or something like that. Let's say it's 10 to 15. So some investors are reluctant for a deal this small to pay even to an SEC attorney. So so how would that work? So here it would be maybe a even higher fee for an attorney that is acquainted with sort of the SPV process and the tokenization side. And are there you're saying there are no other fees at all, right, for the tokenization itself, unless it's a cash offer, assuming you're extending a loan on it. It's basically that's how you guys make money. So it's not there are no other fees besides, I assume, sort of an attorney that would structure the deal. Is that accurate?
Yeah.
Something
when we are tokenizing properties, usually we are covering all those costs. You can say from attorneys and so on if you are borrowing from us. So we have attorneys as part of our team, and we have created a streamlined legal process to prepare Reg D offerings, Reg S offerings, token purchase agreements, and so on. So we have a pretty streamlined process to do that. And our fee basically if you're not borrowing monies, including the legal documents as well.
Understood. Wow, that's really great actually. On the finance deals, especially, like, it sounds like. But then
Could I ask a question? So yeah, so I wanted to understand, let's say that I wanted to set up a fund, simple amounts. Let's say it was a $5 million fund that is going to invest in multifamily. So it might act as a co-GP or as an LP in different multifamily projects. And could I set up an SPV and then use you guys to basically help sell tokens within that fund? And then the fund currently, when it's selling those tokens, does not have a property under contract, but the purpose of the fund is to go and find properties and put them under contract and own pieces of various properties.
Yeah, I mean, you can use tokenization in a lot of different ways. So you can raise a blind fund with tokenization as well. It's just matter, of investors that's gonna invest in that fund. So it just what is going to be their perception. Usually it's harder to do that, but in theory, the tokenization is not limited to try to raise money that way as well.
So my question being is that something that your organization helps with, and what would be the cost of, let's say, if I wanted to sell tokens in a fund?
You want to sell tokens in a fund, or to use tokens to raise money?
Yes, I'm raising money and I'm structuring it so I'm selling tokens in that fund, and the fund is then going to go out and buy properties.
Yeah, you can do that. I mean, we can tokenize such fund basically, and you can go and raise, or we can raise money on our marketplace. Usually it's harder to raise funds for a blind fund. That's the reality, but in theory, I mean, we can do that. There is no limitation. We can structure such a deal.
Yeah, but then Viktor, that's like enormous value add, right? On top of the traditional syndication process, because that essentially means what you're saying is one can sort of structure a private equity fund, which is probably like 6-digit in attorney fees here in the US. So that's sort of, I mean, is that viable? Like, to what extent one can do it to any limit? Like, if one was able to raise, huge amounts of money, such as the full private equity fund sort of assets, let's say 20 million or something, is that's there's no limitation, sounds like?
Yeah, of course. I mean, the setup is the same, you're just changing both numbers.
I would say to an investment manager, now that is the enormous sort of value add, right? I mean, that's what we have in the traditional space. In the traditional space, basically everybody is a syndicator because it's really expensive to have a private equity fund, right?
Yeah, it's just, that doesn't make it, I mean, it makes it easier, but still you need to, to have the credibility to go there and raise the money, because people are not throwing money just because it's tokenized.
Can you elaborate on what type of value that would bring, or the access to that money that would bring?
So the value is everything that I said, but the value is coming when mostly later on. So it's not the initial sell where the tokenization is gonna help you. It's later on. For example, for the investors, they can participate in this fund in the very beginning, but they can exit easier, and that's the value add. So if I'm an investor and I want to join, for example, your fund, and I want to put, let's say, $1 million, at some point, the value proposition is that I can exit whatever I want to, or I can borrow against my equity in that fund. So that's the value add. So I have liquidity. That's the main value add.
Then, okay, Victor, so that's great what you're saying, but then let's say to like again, a typical commercial real estate investor, right? He purchases a property, he tries to raise the net operating income, he wants to realize his own value adds on that deal, right? So now that can be partly based on illiquidity. Why at all he's able to do it. So it's kind of, again, in that sense. But let's say he tries to do that in the scenario in which the ending value is going to be determined in the secondary market by purchasing and selling. How is his, it's basically, I assume it's going to be a higher efficiency in that scenario. So like him raising the net operating income by, let's say 15%, is it going to be, properly realized initially? And I mean, I assume that's going to be more proper, I assume it should be. But, in the other scenario, you have like professional appraisers coming out, assessing market caps, etc. I'm just trying to gauge like the risk to let's say to an investment manager who is trying to raise the value of his property, like by improving it, sort of making it a, better place for people to live, etc., and sort of raising its operating income.
Yeah, I mean, it's like every typical investment. Basically, if you increase the net operating income of property, you're gonna increase the price as well. So is that gonna be proportional with the amount of net operating income increase? You don't know. It might be even more than expected. It's a market out there. So whatever, if you have a buyer that is willing to buy at the cap rate that is serving you, then you're gonna sell it. It's not like you're going there and whatever price somebody's giving you, you just agree. You're basically setting your price and saying, I want to sell it at this cap rate, and that's it. If you have buyers, then you're gonna sell it. If not, probably you're not pricing it correctly. That's like,
Makes sense. But then if you tokenize, are you able to put can you go back? Let's say, can you sell it the usual way, or that's not?
Yeah.
Theory, like how, let's say it's already tokenized, like are you able to sell it, just as a backup, if you don't like the price in the secondary market or something, are you able to sell it yourself?
Yeah, of course, you can sell it. It depends only if, for example, you use the tokens as collateral, you still can sell it. That's not a problem. You can sell the property with the approval of the lender, which, for example, let's say it's us, like in typical mortgage scenario. So then you can execute a traditional transaction, sell the property traditional way, and we're getting our our funding, for example, and you're getting the rest.
Right, but Victor, okay, I get it somewhat high level, but let's say if some of the investors in that in the digital security tokens, they sold their, well, okay, they sold them to other investors, etc. But basically, there's at the end a certain set of those investors who purchase those tokens, but you sell it in the regular way. So I mean, then the buyer has to know that it's still he's still buying a tokenized piece of real estate, right? So
yeah, I mean, you can't if you don't have possession, or with the group of investors possession of 100% of the tokens, you can't reverse it. But get it that way. If the property is making 5%, let's say that you're having 5% cap rate, and you want to sell it to the market, a typical investor usually wants to buy and hold a property just because believes that it's going to appreciate, or just because he's happy with the 5% return. So basically, that's the usual driver. People are either going to do it because of the cap rate, or they're going to do it because of cap rate and appreciation. So they could decide on that and make their investment decision. So it really doesn't matter if it's tokenized or not. In the end of the day, most of the investors are looking at the numbers. So if the numbers make sense, they could buy it. If the process of buying it is much easier, that's going to incentivize them to, let's say, to prefer to buy tokenized asset compared with traditional asset, because that's going to save them time and money. And yeah, but in theory, you can reverse the transaction as well.
So let's say you have 10 investors that at the beginning gave you the down payment. How would you go about reversing this potentially in that scenario?
Right.
Let's say you have just 10 investors at the beginning of the transaction and they didn't change, they didn't sell their tokens anywhere.
Mm-hmm.
And you want to, and at the end you look at the secondary market, you're not liking where the market cap is there or whatever, you're not liking the price for some reason. So you think, okay, I can sell it myself at a higher, I have like whatever good, a good capacity to, to realize a sale. So let's say, how would you want to reverse it? So how would that work in that scenario with those, let's say, 10 investors?
It's the same, like, doing it just traditional way, because you are 10 shareholders in a company, and you're selling an asset pretty traditionally. Nothing is different than, you're just holding your shares in a digital form. If you're having a mortgage, or you have used your tokens as collateral, but you all agree, let's say, that you're gonna sell it, that's perfectly fine. You can do that. We're just gonna withhold some of the funds from the transaction.
Viktor, they're currently owners of, well, I don't know if they're owners, I don't know exactly the legal situation, right? But they have their shares in the SPV that, has the digital certificates against the property, right? So how, if you sell it the regular way and not sell the shares, what happens to the shares, basically? Or how do you reverse it? I'm just trying to understand that.
No, I mean,
that's like some of the concerns, like you don't want it to do it, So
how you're doing it today? You're holding shares in a company, and you want to sell the property, change the ownership. How you're doing it? It's the same thing. It's no difference. There is no difference.
okay, so that's okay, good. So that's good. So what you're saying that you don't really need to reverse anything on the tokenization. If you wanted to sell it to the traditional real estate market, go through a broker or whatever, you can still do it, and then the corresponding shares, the corresponding portions of that sale to the shareholders.
Yes.
Tokenized shareholders. Okay, sounds good. Okay, that's great then. So the reversal, when you said before reversal, that's not really necessary. That's just a sort of theoretical scenario, but it, sounds like there's no need for that. So. Mm-hmm.
Yeah. Usually the problem is if, for example, some of the shareholders are not willing to basically sell it that way. So that's a scenario that could be considered, and based on the shareholding agreement, shareholders could vote either to do that or not to do that, and those are legal implications that could come based on, for example, somebody that doesn't want to sell while the rest of the group wants to sell it. But this is the same with regular entity, right? I mean,
right. Yeah.
So nothing is different than what is basically we're having today, in a way, but it's just we're adding additional layer of liquidity, efficiency, so to say, huge efficiency, and secondary markets, a new way to basically source their terms, premiums for the transaction and so on. If you can find it there, you can still execute transaction the old school way.
Okay, yeah, that's great. That's amazing. And you mentioned some of the secondary markets actually, but on the capital raising side up front, are there certain platforms for capital raising the initial token, so to say?
We have a crowdfunding platform, but yeah, we are not basically. I mean, our platform could be used, but we are not investing in marketing and stuff like this because it doesn't make a lot of sense for us from a return standpoint. So to say, I mean, we can cover the investment of doing so. To promote the
Are there some big you know, tokenized real estate crowdfunding platforms? Let's say you can share with our audience in that sense, or it's still pretty much, you know, in a beginning phase?
Yeah, it's very early stage. I think we have the probably, I don't know, even another platform that is operational. But you know, our platform could be used because we have KYC AML procedures in place and stuff like this, which could be used to onboard investors. Just it's easier to streamline the investment process through the platform. But yeah, we are not gonna go directly and fundraise because it just doesn't make sense for us. If the issuer wants to, let's say, syndicate deals and use the platform, that's fine. We can do that.
Got it. And possibly my last question to let others as well. So in terms of what you mentioned, let's say what I think Andrew was asking with regards to like sort of raising money up front, sort of structuring it as a fund rather than on a deal by deal basis. So I mean, in the traditional space, the SEC, and you did mention SEC involvement before in tokenization. So in the traditional space, SEC obviously is you know, has huge involvement in that, and there are reasons why if you do this, such as raising up money up front and not on a deal basis, you are going to sort of have a, you know, a different process and, you know, maybe higher attorney fees, etc. So how come that's avoided, and like aren't they putting, you know, certain obstacles to that? You know, I'm just trying to understand because it's still, you know, they would assess it like conceptually it's the same thing. Like aren't they concerned about, you know, such easy capital raise in this manner? You know, don't they want to sort of monitor this in a efficient way?
It's not easy and it's not different than a traditional one. It's just we have simplified the process. The process of, you know, preparing the documents and so on. Other than that, you're having the same documents, like 60, 70 page private placement memorandum, for example, for the offering, token purchase agreement, which is a shareholding purchase agreement basically, and you're having you know, all those robust documents just prepared for such type of fundraising. That's what it is, and basically you're selling securities, so you need to comply with SEC regulations if you're an issuer, and then, for example, those offerings are working with trade investors, so we can't solicit retail investors in an offering like this. So there are certain rules that we need to comply with when we're fundraising, for example.
So let's say one capital raise up front, let's say a big amount, $10 million. And then, you know, there's no lending that you're doing at that point just yet.
Yeah.
But you know, conceivably he could be investing in a financed manner subsequently, you know, sort of borrowing for his actual deal subsequently. So how would your fee structure be in this scenario based on that? He could be borrowing afterwards and also, you know, just even in the first place. So is it going to be like 100 grand of 100,000 in a fee, or is it going to be like substantially less than the current private equity space?
Our fee, if you know, if you're not borrowing, is 20,000 for tokenization. It could be you know, structured as a fund. It could be a property that you want to sell, for example. And want to tokenize, so and you want to sell it to Reg D offering, but in the end of the day, you need documents. documents. You know, you need the structure, the Reg D documents, the Reg S documents. If you want to go, let's say, to a Reg A offering, then it's going to be different because we don't have the documents for Reg A offering, which I don't know how familiar you are with those security type of different offerings, but Reg D basically allows you to raise money from great investors, while Reg A basically is like mini IPO, and you're able to even list your shares on Nasdaq, or you can publicly trade your shares, and you can solicit retail investors as well.
Yes. Okay. And that's great. That's great. But if you do a single deal and there's no loan, like you said, and you pay $20,000 to to tokenize this deal, so that's your fee. But if you do it upfront and you are going to be doing multiple finance deals later, let's say they're all financed, they're all with mortgages, with lending. I mean, lending through your platform. But is that going to be again 20,000, or is what's going to be the economy of scale? I'm trying to understand for somebody doing a fund, which is Andrew's question.
I mean,
that's a very important conceptual question, I think, to everyone here, because I think that's like an enormous value. I mean, I don't know if you agree to the space.
Yeah, if I mean, if there is no borrowing associated immediately into that deal, we can't test it out to see if somebody is gonna fundraise for their fund to basically postpone our fees, let's say, for the future. Because
okay, so let's say just a flat out no consideration of future borrowing or not. It's just not borrowed at all. Okay, so he just raises straight like 10, 20 million, like it's a big amount. So how would the fee scale? Like, I'm not trying to dig into your fees so much.
Oh yeah, no. I mean, it doesn't matter.
The economies of scale of that, because that's that could be a great sort of a great, I think, value to to investment managers. So.
Yeah, it doesn't matter if you're raising 100 million or a million from our perspective, because the work is absolutely the same on our end.
You're saying for a blank sort of capital raise versus for a where the property is identified, it would be
it's the same.
Similar documents still, even though the property is identified in the other scenario.
We just have documents for blind check fundraisers, so they're different.
So they're different. Also, like 20,000.
Sorry.
That could also be 20,000 in that case.
Yes. But if you want particular, a different customized deal structure, because this is like everything, some people might say, okay, I want those and those points to be different. I want not to allow my investors to do this and that, and start customizing the documents. Then attorneys are still charging $400 an hour. So if we start from scratch,
that makes sense.
Changing documents, that's
Victor, I got a quick question for you. So can you walk me by the actual liquidation of the property? Like, does it kill its tax incentives for the next person? Like, how are you leaving meat on the bone, like for the value add and for the appreciation of the property going to the next seller or next buyer, excuse me?
Yeah.
Because I would assume if you tokenize it, then you're not really paying off the loan, or not really losing, like the value is almost stagnant. I mean, it may appreciate a little bit based on the majority token holder, I guess you would call it, but like, because you can't do any bonus depreciation on it or anything, or can you? Maybe that's my question.
Yeah.
And how does it change, like also with opportunity zones? Like when you take into tokenization with opportunity zones, it almost seems like a perfect fit.
Yes, it is. It is. It's also there is an amendment that is coming for 1031. At least I know that they're considering amendment for 1031 exchanges. So if you're buying tokenized real estate, you're going to be able to use it as 1031 exchange, which is much better, because if you need just to bridge a transaction and avoid paying some of the taxes until you find the right property, you can buy tokenized real estate and then sell it quickly when you find the right property, the right investment for you. From a tax standpoint and appreciation standpoint, I mean, the property could appreciate and the token's price could goes up as the value of the property going up as well. So we should just consider what are the drivers of price appreciation. This either growing rents, for example, or growing net rent income of the property. So if we're selling at 5% usually at that market, and or 3.5% like in Manhattan usually, let's say we're still trying to get those 3.5% cap rate, or the investor are trying to get 3.5% cap rate. So that means that if the rents are going up 10%, we're gonna have 10% appreciation in price overall. So not much of a difference here in the way how investors are gonna evaluate the deal. There could be a little bit of more willingness to take lower cap rates over time if the space become a bit overhyped, because on that market easily you can compete as an investor with international buyers that are willing to take, let's say, a property that is making 3% or something like this, for example, while, for example, a local investor is looking for 3.5%, which gonna inflate the price a little bit. But those are just theories, so basically.
Actually, Victor, just another question. I know we're like super over time, and really thank you for all your answers. Actually, that's so useful. But I want to confirm, like, because when we say, for example, you have you have your initial capital raise, it's and there's like certain portions to the investors contribute. Okay, but then the project itself, there is a certain profit split, right? So let's say like a standard waterfall, like let's say 70-30 split, above an 8% preferred return and things like that, right? So in the subsequent sale in the end at the open market, so, or let's say in determining like ownership, sort of tokenized ownership, is it sort of doing the arithmetic of okay, the 70-30 split over the 8% pref, and then the sponsor of the project has, let's say, 13% in the deal, and then the rest 87% are distributed? Like, is that the final set of numbers there? I'm just trying to understand that will then be traded on the. So how, in the sense, if the sponsor wants to sell the whole deal at the end, how does he go about selling the whole deal since it's so tokenized in portions, right? I mean, this can.
Yeah, I mean,
what are those components? So.
Well, when we're talking, those are a bit out of the box solutions that we don't have ready to go, so to say. Those need to be considered, on a custom basis. So if you want to structure it that way, that's okay. I mean, it could be structured that way in a way that it's going to work and still be flexible. So the investors are holding their tokens, and the general partner could hold also some part of the tokens. I don't have solution right away for you. I mean, there is a way to structure it for sure, but instead of throwing you solutions, out of the blue. I can tell you that it could be done, but it's just a matter of setup.
Yeah, understood. But let's say even in just in any setting, let's say they're investors and still there's some compensation going to the sponsor, right? So how is that portion sort of allocated in the tokenized?
Oh yeah, I mean it could be
Tokens.
an easy setup could be that basically you're having 100% that you want to distribute. So the sponsor, just because of his work for that project, getting all the investors together and setting up the deal, could be compensated a flat percentage out of the 100%, let's say 20%, and 80% are held by the investors. So that way the investor could execute a sales transaction of his, the sponsor could sell his 20% whatever he wants to, and that's creating sort of a free market and ability the investors to get out of the deal by themselves without asking the sponsor, hey, is it a good time to sell now? Or...
Yeah, understood. But even for the sponsor, this is enormous. Again, I think it's enormous value add, right? Because the sponsor does not need to sell the whole project anymore. He can sort of sell his 7.5% in the deal, or whichever it ends up with when the the legal process gets set up. That's what that's kind of what you're saying.
Yeah, I mean it's very simple. Just change of the way that you're structuring it. Instead of having the general partner sort of structure and LPs, you can just get your shares and be like sort of an equal partners in a way.
Yeah, got it.
Yeah.
Yeah. So I have a question. So let's say I buy this tokenized real estate or tokenize my property and then sell the tokens. What are the capital gains tax?
Like pretty regular capital gain tax. Well,
traditional way.
Yeah, very traditional.
Okay.
It's like depends how quickly you are doing the transaction. You're gonna be taxed that way, but it's very traditional. Based on, of course, where you're based and so on. So I don't want to give you any sort of advices here.
Okay. So if you're saying right, so if I have a $1 million property and then I tokenize half it off, I should be ready to pay property sales tax on the half of it that's gone, tokenized.
If you tokenize the property and sell it, I mean, if you have, so to say, 100,000 worth of tokens and you sell them for 150, you're gonna generate 50,000 worth of capital gain that is taxable.
Right.
And, yeah.
So capital gain plus sales tax, right?
Plus sales tax. I
sales tax.
So. I don't think there is a sales tax for selling shares.
Okay. So if I buy, so I say I'm a buyer of tokenized this real estate. I go to market. I think it's super fun. I buy $5,000 worth of tokenized real estate, just like stock, right?
Yeah.
The values go up, all of it go up. And if the primary owner who owns 80% it sells off and I get a little benefit of it and then keep owning it, right? 20% all the way, or by $5,000, it's gonna make up some numbers. And then if I sell it, I have to pay capital gain tax on that, just like I'll sell something along the line. Something you expect, yeah.
Stock is a good example. It's like realizing capital gains from stocks. So if you, you are not anyhow related with the owner who is holding 8%. I mean, he might do whatever he wants to with his 80%, while you're holding those $5,000 and you can hold them, and the market price could be $10,000 right now for your 5,000 initial investment, and you can sell it You can hold it. You can do whatever you want to. If you sell them 10,000, you're gonna realize 5,000 capital gain, and you should pay the taxes.
Sure. I thought you mentioned that it's actually different from stocks, right? Because there is at least being potentially different because there is worked on the 1031 exchange. So in that scenario, the capital gain would sort of, well, be extended in time until you keep 1031 exchanging. So
Yes, yeah. I mean, but
we have for stocks. So and I don't know what's the reason that they would do it like that for tokenized real estate, since it's for real estate investment trusts. I'd assume, and I've never purchased any myself, and neither do I intend to. But like let's say for example, there you would not, there's no you can't 1031 exchange. So unless
it's not still considered. I'm not sure. From regulatory standpoint, it's not clear if right now if you're holding tokenized real estate, if that's going to be considered a 1031. If you can use it for 1031 exchange, but it's coming. As far as I know, there is amendment that is coming, and you can use it for 1031. You're gonna be able to use it for 1031 in future, and you can basically postpone the payment of taxes.
in which case it's going to be then different than stocks, which is great. So that's going to be very much more beneficial, so.
But now it's still not there. So now it's still more like a stock.
Understood. Yeah, that is some important consideration, in general, currently, but yeah. Okay, that's good. Janice, I think you're the only one on actually currently. Do you have another question?
No. I've been really appreciating the interaction, and then the questions asked by audience. I really value that. So it's something that new. So thank you.
Okay, that's great. Thanks so much. Yeah, thanks for joining. And yeah, Viktor, so that was great. Thank you for your extensive, excruciating kind of interrogation that you went through here. So really appreciate all your input, and it sounds great. I think it's really exciting stuff, and
awesome.
It's going to revolutionize, improve the space. So thank you for your work, and thanks everyone for joining.
Thank you guys. Thank you for inviting me here, and it's a real pleasure.
Yeah, and actually, what are some ways that people can reach to you?
They could find me on LinkedIn, for example, or they could check our website. Easily to and reach out directly to the website form.
Okay, sounds great. Okay, thank you so much.
Thank you. Bye-bye.